Hi friends, in my next few videos we'll discuss about mutual funds. It is equally important to understand the tax aspect of the mutual funds, because whenever we discuss about the investment, it is important to understand the post-tax return. In this video, Krishna Khandol will explain in detail about taxability of mutual funds.
Hello everyone, my name is Krishna Khandol and I am a CA final student, and in today's video we are going to talk about several tax planning opportunities which are available regarding investments in mutual funds. Now, observing the trends, we have seen that people tend to invest their monies in fixed deposits. So in today's video I'll be talking about fixed deposits versus equity oriented mutual funds versus debt oriented mutual funds and all their taxability aspects. Now, starting with taxation of fixed deposit. Now, fixed deposit interest is taxable on the basis of accrual. Simply put, that if you have a deposit of rupees 15 lakhs for the period of 3 years, the deposit will mature after the period of 3 years, but the interest shall be taxable every year. For a better understanding, let's have a look at an example. Suppose you have a fixed deposit of rupees 15 lakhs having a maturity period of 3 years, and let's assume that the rate of interest is 6% per annum. So, at the end of first year, your deposit value is 15.90 lakhs and tax will be charged on rupees 90,000. Now, here to simplify the matters, I have assumed the other taxable incomes earned apart from interest are above rupees 10 lakhs and hence tax rate would be 30%. So now tax on 90,000 at the rate of 30% is rupees 27,000. Now similarly, in the second year, tax will be charged on interest at the rate of 6% on rupees 15.90 lakhs and it will be 95,400 and tax would be 28,620. And in the third year, tax will be 30,337. In the end, for the income of rupees 2,86,524, tax would be paid of rupees 85,957. Now moving on to taxation of debt mutual funds. So in debt mutual funds, the investor will be required to pay tax at the time of redemption, which means you do not have to pay tax each and every year, but only when the amount invested is redeemed by the investor, as compared to fixed deposit in which interest shall be taxable every year. Now, whenever the investor decides to redeem the amount, capital gain comes into the picture. Now, assuming that the investor will redeem the amount after the period of 3 years, long-term capital gains comes into the picture, and it will be chargeable at the flat rate of 20% and benefit of indexation will be available. Now, what is indexation? Then simply put, indexation means inflation rate. Okay. Now, generally assuming the inflation rate of 5% per annum, the total for 3 years amounts to 15%. Now, after deducting such inflated cost, the remainder profit shall be taxed as capital gain at the rate of 20%. For a better clear understanding of what I just said, I have drawn up an example which will be shown on the screen. Okay. Now, I have assumed the same amount of investment of rupees 15 lakhs and return of 6% for the period of 3 years. Now, assuming that the investor redeems the amount immediately after the completion of 3 years, we can see the tax that has to be paid on such redemption. We can also see that we receive the same amount of return each year as we did in fixed deposit, but the tax is to be paid only after the redemption. Now, to understand the working of long-term capital gain, we previously assumed that the inflation for 3 years is 15%, which makes our inflated cost at rupees 17.25 lakhs. Now, after deducting 17.25 lakhs from 15 lakhs plus interest of rupees 2,86,524, the taxable capital gain comes to around 61,524 and tax payable comes to 12,305, which gives us an effective tax of 4.29%. Now, moving on to the last part, taxation of equity oriented mutual funds. Now, even in equity oriented mutual funds, tax is to be paid at the time of redemption. Now, that gives us two possibilities of short-term capital gain and long-term capital gain depending upon the time period of investments. So, if we invest for a period of less than 12 months, it is considered as short-term capital gain, and if we invest for a period of more than 12 months, it shall be considered as long-term capital gains. Now, long-term capital gain has two more advantages. First being, it shall be taxable at flat rate of 10%, and second, it gives us a basic exemption of rupees 1 lakh. but on the flip side, the benefit of indexation is not available. To get a more clear understanding, we have an example. Now, to keep the matter simple, I have assumed the same amount of rupees 15 lakhs and return at the rate of 6%. In this scheme, we have a tax planning opportunity that the investor holds the investment for 12 months and sells it the very next day and invests in the same scheme again the very next day. Now, doing this provides us a tax exemption of rupees 1 lakh per annum. The table given shows the calculation based on this presumption. And so we can see that after the basic deduction of 1 lakh and after 3 years, there is only a minimal tax of rupees 110, which gives us an effective tax rate as almost nil. Now, when we compare all the three options that we discussed, the effective post-tax return of that of fixed deposit is 4.2%, of that of debt mutual fund is slightly higher at 5.74% and highest in equity-oriented mutual funds at the rate of 6%. To summarize all the options, the chart will be shown on the screen. To give a more clear understanding, I have also summarized the taxability aspects of all the three options in this chart. You can screenshot this for your future reference. In the end, I would advise the investor to research the tax planning opportunities available to them so that they can make investment in safe and secure mutual funds to maximize their gains. Do let us know in the comment section below how you like this video. Like and subscribe to the channel for more such videos in the future, and I'll see you next time.